Welcome to Golden Larch Investing. My name is Liam, and in today's video, I'm going to be diving into the race to become Canada's go-to green energy company. As the world shifts its focus to green energy, Canadian companies have the opportunity to step up and take the lead. In this video, we're going to be comparing three major players to determine which might be the best investment opportunity and to give you the tools you need to invest into green energy. Before we jump into our head-to-head comparison, let's talk about why you might want to invest in Canadian green energy. First up, this is a massively growing industry. The renewable energy sector is booming and it shows incredible long-term potential. With a global effort to combat climate change, this industry is set for exponential growth in the coming decades. Second, we have government support. With favorable policies and incentives, the Canadian government is all in on green energy. There are many rebates in the Canadian economy supporting green energy, most famously the Canada Greener Homes Grant, which gives $5,000 for efficient green energy home upgrades. The third reason is portfolio diversification. Investing in renewables can help diversify your energy portfolio. As traditional energy sources face increasing scrutiny, having a stake in green energy can provide a hedge against market shifts. Fourth, attractive returns. With the growth of the industry, potential for returns is looking pretty enticing. Many renewable energy companies are not only growing rapidly, but are also offering attractive dividends to investors, which offers solid dividends now and great growth in the future. The renewable energy market is set up to grow exponentially in the future, with technology like electric cars and artificial intelligence just fueling our need for electricity. All right. So how do we determine which company is leading the pack? Today, we're going to be looking at three key performance indicators or KPIs that I've picked out to help us choose. These metrics should give us insight into the companies themselves in their financials and their future potential. Our first KPI is revenue growth. Considering that most renewable companies are currently losing money, revenue growth is probably the best indicator of how fast each company is growing and how much market share they might capture. This is crucial in order to pick a company that will be able to maintain competitiveness and hopefully establish dominance in this emerging market. Our second KPI is earnings per share or EPS. Even if these companies are currently investing heavily and so losing money, earnings per share can help us see who's been effective at managing their finances. A company with a higher EPS, even if it is negative, likely has a longer runway and better prospects of creating future profitability. Third up is return on investment or ROI. This metric reveals how well a company's management is allocating resources. A higher ROI means better decision making. In the renewable energy sector, where large capital investments are common, ROI is crucial. Now, let's dive into our three contenders. First up, we have Brookfield Renewable Partners. Brookfield is a limited partnership based in Toronto. It's one of the largest publicly traded platforms for renewable energy, with a very large and diverse portfolio of assets. As the name suggests, this company is primarily owned by Brookfield Asset Management. So let's look at Brookfield's revenue growth. They currently have a 10-year revenue compound annual growth of 11.37%. This has been lower over the last 5, but it's still an impressive growth rate. For their EPS, Brookfield's currently sitting at negative 18 cents per share as of the end of 2023. While this is negative, they have had several years of positive EPS in the last decade, and seem to be trending positive, at least since 2022. Now, return on investment. Brookfield's currently only sitting at 3.07%. This seems pretty low, but let's wait and see what the others look like. Brookfield's shown pretty impressive revenue growth, thanks in part to their global presence and diverse renewable assets. They have operations in North America, South America, Europe, and Asia. And so they are well positioned to capitalize on global renewable energy trends. Our second company on the list is called Northland Power. Northland Power is another Toronto-based producer that is focused on wind, solar, and natural gas. They seem to specialize in offshore energy with some of their most impressive projects offshores around the world. Looking at their revenue growth, Northland's sitting at a 10-year compound annual revenue growth of 14.89%, which is a very impressive number. However, in the last 5 years, they've only returned 7.5%, which is a brutal decline. Their EPS is sitting right now at negative 69 cents. This is pretty brutal compared to 2022, where they made $3.46 per share. That's a little bit worrying, and again, we're going to have to see how 2024 rounds out for this company to see if this is an outlier year or if there's a downward trend here. Their return on investment is actually pretty good. They're looking at about 10.98%. And compared to Brookfield, that's a very impressive number. So far, this firm is looking pretty interesting. Northland is really making waves in their offshore wind projects. They're carving out a niche for themselves, and they have been particularly successful in Europe. However, important to note, this is not a 100% renewable energy company. And while that natural gas business is a very valuable asset in the short to medium term, it might be a drag on the business in a future where hydrocarbons are phased out. Our third company today is Algonquin Power and Utilities. Algonquin Power and Utilities Corp is based out of Oakville, Ontario. They operate two business groups, with one being a utility and the other being the renewables business we're interested in today. They're sitting at a very impressive 10-year compound growth of 15.58% and a 5-year of 10.4%, by far the best in the group. Their earnings per share is sitting at a positive 4 cents. This is our first positive in the group and has come with only 1 year of negatives in the last 5. However, keep in mind, these numbers are combined with their utility and their renewable energy business. With that in mind, let's talk about their ROI, because this is really their downfall. They're only looking at a return on invested capital of 0.96%. It's a really tough number and shows that while the company is currently making money and they're growing in size quickly, the investments they're making right now are not the reason for their growth. Algonquin has a unique mix of regulated utilities and renewable assets, which does help stabilize their financial performance. They're definitely in the mix with a diversified approach, offering some steady cash flows and some growth. Now, before I pick my favorite of these three, I want to outline a few industry trends that are helping inform my decision. Number 1, technological advancement. We live in an era of rapid technological advancement with things like battery storage and smart grid technologies making renewable energy more and more efficient over time. This means that investments made in the next 5 years will probably be more effective than those made in the last 5 years. Second up, policy changes. Canadian government has been committed to net zero emissions by 2050. This is driving investment into renewable energy in Canada, but this might not be something you should depend on. Consider that the upcoming political changes are likely to happen. You might not have those same goals in the near future. Third, we have corporate demand. With large corporations increasing their need for power, setting renewable energy targets, or otherwise focusing on green energy, there are consistently new opportunities for partnerships and expansions. And fourth, we have international expansion. All three companies discussed today are looking beyond Canada's borders for growth. They have a strong foundation at home, and they might find themselves able to compete on a global scale. This is something that very few Canadian brands have done well over the last few years. Let's start to wrap things up here. So after all the analysis and after considering industry trends, one specific company stands out to me the most. Brookfield, being the completely renewable energy play, just fits best into my portfolio. With their consistently strong growth, break-even financials, and with really strong financial backing, allowing them to invest more into upcoming projects. I think this is the one that I would want in my portfolio. But remember, the renewable energy landscape is constantly shifting. Always consider your own risk tolerance and do your own homework before investing. Each of these companies has its strengths, and the best one for you or the best deal at the time you're looking might depend on your investment goals. Thanks for tuning into the channel. If you enjoyed this deep dive into Canadian green energy stocks, please give this video a like and hit that subscribe button. And hey, if you think another renewable energy company offers a better long-term future than the ones explored today, please leave a comment down below. I am always interested in learning more about the Canadian stock investing world. Until next time,